Welcome to the Wealth Under Pressure podcast. Financial success very often has less to do with owning a financial product, earning a high income, or even being frugal. Instead, the path to success comes from having a comprehensive plan that enables you to optimize decisions and avoid mistakes. Join John Smallwood, a certified financial planner, as he identifies key areas of pressure on people's wealth and strategizes to reduce it. It's time to liberate your wealth.
Hello and welcome to episode number 6 with John Smallwood. Now, today we're going to really talk about starting tax planning now. Now, it's the end of 2017, and there's some stuff that's coming down the pipeline. And so when John and I were talking about this podcast about starting your tax planning now, my immediate question is going to be the immediate question that I ask you right away, which is, how in the heck are we supposed to plan for taxes now when we have no idea what is coming down the pipeline, man?
It's true. It's so important to understand where you are now, because this is going to impact your bottom line. It's either going to be positive or it's going to be negative. And if you don't know where you are now, you're really not going to understand the impact of how this tax law is going to impact you. Most people that I encounter pay more taxes than they should. Their financial strategies are implemented in a manner that increases their taxes, and they're paying more taxes than they should. This is the problem.
Well, and that's a terrifying problem. And really, gosh, somebody's really not looking out for them if they're encountering that sort of problem. Let's break that down a little bit. Let's talk about what are some of the things that you do from your vast experience to do what I would agree with you as proper tax planning.
Well, one of the foundational parts of a financial plan is getting very clear on the present plan. Where are you now? And you need to understand, or the person, the client, the individual, the business, whatever you are, you need to understand, where does my income come from? Where does it show up on my tax return? How is it taxed today? And more importantly, how will it be taxed next year and into following years? Now, I'm not saying next year with the new tax law. I'm saying just general, if the tax laws do not change, how is that going to be taxed tomorrow, the following year, the year after, the year after? And you need to get the strategy. 90% of the people show up in the office and they have no clue how much tax they're actually paying, where the tax is, how it's being generated, and is there a better way to get it done? They're missing deductions. I mean, it's just, and this is not due to bad accounting. It's typically due to just not having a focus on a tax strategy.
So how do you uncover that, John? What is the, I mean, I'm not trying to have you give away your entire secret sauce here, but give us some of the sauce. Tell us how you figure this stuff out.
No, I mean, this is basic, okay? So when you sit down, what you want to look at is, there's two different types of people, and you need to visualize who you are. I either work for somebody or I own my own company. And that company is either it's going to have some sort of entity. It's going to be a sole proprietor. It's going to be an S Corp, an LLC, a C Corp, a partnership, pass-through entity. Everybody's talking about that. Or I work for a large corporation, and all of my income is W-2 from an earned income perspective. And that's going to show up all typically on line 7 on a tax return, which is wages, okay? So what you want to look at is, and I'll often do this with a lot of clients, is you take out your tax return and you look at last year's tax return. For most people, that's 2016. You got a salary. You have interest. You have dividends, qualified and non-qualified. You have tax refunds. You might have alimony. You have business income from a Schedule C, which is self-employment, capital gains, IRAs, pensions, rental real estate, S Corps, LLCs, farm income, Social Security benefits. These are things that they all show up on that first, line 7 through line 22 on the tax return. And all of the investments that you're making also generate income that will either currently show up on one of those lines or in the future show up on a line. So for a lot of people, it's the first time in their lives that they actually understand how everything is coordinated together. So that investment put this on my tax return in the form of interest or capital gains or capital losses. So what you're looking at is, okay, this is what I currently have. Then you go through it and say, well, I have a mortgage. I paid interest. I have real estate taxes. And this is one of the big things that's in the new tax law is a thing called SALT, S-A-L-T, state and local taxes. And when you go to your itemized deductions, there's medical expenses, there's the state and local taxes, there are charitable contributions, and there are other deductions. Those state and there's mortgage interest deduction. These are really important pieces in understanding how is that benefiting me or not benefiting me. And it's a basic conversation, but it's kind of like a puzzle board where you take what you have, you organize it, you put it on the tax return, and you see, based on everything that I have, this is what's taxable, what's not taxable, what kind of deductions am I getting? Am I getting the right deductions on the plan? What am I missing? What am I not missing?
You talked about it being a puzzle, and you're right. I mean, it's a puzzle, and for most pieces or people, there are many pieces that are missing. How do you help them find those pieces? Now, you said it was basic, but part of long-term tax planning, and what I'm hearing you say is there's a substantial amount of experience and knowledge that you as the consumer need to have faith that your consultant, your advisor, your financial services professional has. Would you mind telling us a story of somebody who came in and we're all cattywampus and we're all over the place, and because of your discovery and your planning process and making sure that you know where they are now, that you were able to get them right?
Absolutely. So very frequently in today's tax law, you have a self-employed person who owns, let's say, an S corporation or an LLC, and they're taking a salary, and they have basically, so the salary showing up on line 7 of the tax return, and then line 17 is going to be let's call it an S corporation distribution. And there's a rational decision that you have to make. And there's a concept called reasonable compensation. But for example, if you own your own company, you might be a professional, you might be a manufacturer, you might be something like that, okay? And the company makes a profit of $500,000 or $1 million. Let's just use that example. It's $1 million, which is what everybody wants, right? But it's all coming through in the form of salary. So that salary is subject to ordinary income tax. It's subject to Medicare, FICA, etc., where there's a concept called reasonable compensation, which if you own your company, you can pay yourself a salary and the rest of it could come out as a S corporation distribution. Now, it has the same, in the current tax law, it has the same ordinary income tax treatment, but it's not subject to the Medicare tax or the Obama tax, which is the health insurance tax, as it's called, to, the healthcare tax on line 61, which above a certain income, you're getting another tax there. So what you tend to think of is the Medicare tax as a self-employed person. If you work for a company, you're paying 1.5%, and the company's paying I think it's 1.52 and 1.52. So it's like 3 something, right? But in essence, for every $100,000 over reasonable compensation for your industry, you're paying $3,000 of unnecessary taxes. If it's a lot of money, it's a lot of money. I've had people, when we've done the math, it's $25,000, $30,000 a year in reduction just from the Medicare tax.
Wow.
As you prepare for next year, one of the things is that the pass-through entity, such as an S corp or an LLC, might benefit from a lower tax bracket in itself. It may not be the same ordinary rate at 39.6 like we're being exposed to, depending on the industry. You've seen that professionals may be subject to 70% of their distribution coming out as ordinary income and the 30% not. But we don't know what it is until it is. But that's a fundamental thing that goes on all the time. And I'll see people, they've got 8 years left on a mortgage or 10 years left on a mortgage. This is another example. And a mortgage is a tool, and the tool is it's deductible debt. And the idea is that I want to maximize the deduction for the payment that I'm making. Does that make sense?
Absolutely. Yeah, I'm tracking right along. Keep going.
All right. So with a short-term mortgage, your interest deduction fades away very, very quickly. Over a 10-year period, it goes from, let's say you have a $500,000 mortgage at 4%. You might have $20,000 of interest in the first year as a deductibility, but by year 10, that's down to $2,000. So that means I'm still making the same payment, but I have very little interest deduction left. Where if I spread the payment out over a 30-year, locked in a interest rate that was very low, I'm now paying less payment and getting a higher deduction for a longer time frame and be able to basically maximize the benefit. And if you look at, and this is something that you can't predict the outcome, and I've been very, very clear on this, but 20 years ago, what were the interest rates?
They were high, man.
All right. So I've been saying for 10 years that interest rates are going to rise, and I've been dead wrong for 10 years.
Wow.
All right. So eventually I'm going to be right. I'm going to stick to my tune that interest rates are going to rise. But if you think about it for a second, if I lock in a 30-year loan at 3.5% right now, 4% or 4%, in 15 years from now, I've accumulated money outside. And let's say the interest rates in our economy right now, a money market account's around 1%, right?
Sure.
So let's just say it's like 15 years ago and you could open up a savings account at a reputable bank and the rates are 6.5% or 7%. Do I want to pay off my 3.5% mortgage?
Well, I would say no.
No, exactly. And if it's like the Jimmy Carter days, we're at 16 and 17%. So you wouldn't want to pay off that mortgage. And if I paid off the mortgage very quickly over a 10 or 15-year period, that means I gave more money to the bank quicker. Because I have less interest deduction, I've paid more money to Uncle Sam. And now the money's sitting in my house. And if I want to get at that equity, I'm now subject to the rates at the current time. So if CD rates are 7%, mortgage rates are going to be a little higher, right?
But I'm going to interrupt you here because what you're talking about here goes against conventional wisdom.
Right.
I mean, that's all I have to say. I mean, you're going against conventional wisdom. I don't know where to go with that. I'm just sitting here thinking to myself, I'm hearing John Smallwood talk about something that logically makes an enormous amount of sense, but it goes against what I have been taught as a consumer.
Right. And we've been taught that we want to get our house paid for. We want to you want to be debt free. And there's, credit card debt's bad debt, but deductible debt is good debt, and you want to use it as a tool. So if you think through the transaction, the short-term mortgage, remember the 4 rules or 5 rules of the financial institutions that we talked about on a previous episode, which was the bank, or not the bank, but let's just say the financial institution wants you to be comfortable giving them money. I have we're very high rated. We have a low rate. You're going to pay less interest and you're going to get your mortgage paid for faster. So you feel comfortable and you do that. And they want you to get that money quickly to them because they're a financial institution. The quicker they get the money, the faster they can put it out into the marketplace and re-lend it, right?
Yep.
Then once you pay down your debt, they don't really want to give you the money back out. But if they do, it'll be maybe at a higher rate, maybe at a lower rate. And they don't want to give it all back to you because it's inside of the house. So what you're looking at is the conventional wisdom. If I follow what conventional wisdom is telling me to do in the face of a short-term mortgage, and there's not a person that I've met that has unlimited resources, okay? Meaning most people that we're talking to, there's a finite amount of money and they're making financial decisions. So if I make a decision to pay off the mortgage quickly and accelerate that debt, make an extra payment or do whatever it is, which is so many people do, as I do that, I'm giving more money to the bank and they get to use it. I lose access to it. And if I need access to it, I have to sit in front of the banker and ask them for a loan. Okay. 2, I'm paying more tax to the government, which is a good thing for the government, but not a good thing for the individual because we could do a better job with spending our own money. And I have less accessible money in the future. So the idea is that if I spread the mortgage out over a 30-year, I free up money. I get to put money in my own account. I pay less taxes. And 15, 16, 17, 18 years out in the future, if I was diligent, I accumulated enough money, and now I'm in the driver's seat to make a decision to pay the mortgage off or not. If interest rates are 10, 11, 12%, why pay off a 3% mortgage? And so many people, when you think about it, this is why I want to get clear on where the taxes are coming from, because if you're going to retire and have lots of IRA income and lots of pension income and a decent amount of Social Security income, every single one of those I just talked about are going to be taxed as ordinary income. You're going to be in the same tax bracket, if not higher. And many people, and this is something that dumbfounds me, but many people believe there's some sort of retiree tax bracket that's different than the working tax bracket.
I haven't heard of that one yet, John. So
yes, and currently that does not exist. So we're in the same tax bracket. So if I'm retiring and I have a good six-figure income coming in from pensions, IRAs, Social Security, I need deductions. And what's really interesting is if you think about Social Security, when your income passes, I think the number's around 40,000 to like 55,000. I don't have the exact number, but if your income's below 40,000, your Social Security is pretty much tax-free. But as you cross through that threshold, you get to a certain number, and 85% of the Social Security is now taxed. So you go from in that $40,000 to $55,000 income level. The incremental tax is tremendous because you have a certain amount of money that's not being taxed that's now being taxed. So the conventional wisdom is have the mortgage paid for in retirement. And the theory is, well, if I can benefit from an interest deduction, it may be very beneficial to me depending upon what the interest rates are and what my financial circumstance is. But it's if I don't have the debt and I don't have it out there, it's not something that I could do because I may be paying a higher interest rate. So you have to think through the transaction for the long run and basically say, I'm here now, I'm heading into the future. What will be my income sources in retirement? Will I be in the same tax bracket or a lower tax bracket? And that's impossible to predict. But I got to say this. Most people don't want to change their lifestyle ever. Actually want to have more lifestyle. And therefore, in order to do that, you most likely, for most people, you want to stay in the same tax bracket that you're in now. So paying less taxes and being in a low tax bracket means you have less income in most cases. Or you lost a lot of money somewhere along the way and you've got big losses like somebody that we know.
Yeah.
So the thing that I see is that because of this conventional wisdom, we don't necessarily make good decisions in the deductions that we have. And what I see is that there are financial strategies that generate a lot of current high-level taxable income, such as short-term gains. Well, if I'm getting a 10% return on something, but it's generating all short-term gains, what's my effective bracket on that or my after-tax return on that? It could be as low as half of that because of the high taxation.
Right.
And you need to, or I see people that have all municipal bond income getting a very low return, and they're not really paying that much in tax. They may be paying a 10 or 15% tax. And if you said, oh, let me take some interest that is taxable, such as like a high yield bond or a corporate bond or something to that nature, and maybe instead of getting 2%, I'm going to get 3 or 4%, but my effective tax bracket doesn't go up. I think the 4% is better than the 2%. So you need to look at this and see if I make these subtle changes, how does it impact my tax number? And I was working with somebody earlier today, and they have student loans, and the student loans are not deductible, and they have short-term mortgages, and they're feeling the squeeze of cash flow. And we looked at, well, what if we refinanced everything, put it into a mortgage, and got rid of all the student loans? Well, they increased their deductions they reduced their taxes by almost 10%, and they increased their cash flow by 10% a year also, which was unbelievable. But we were fighting that conventional wisdom. And it has to be, every financial decision cannot be made in a vacuum. It has to be made in a bigger picture. You have to look at, when I do this, it's going to create this over here. Is this a good thing that's going on? For example, if I get a high rate of return here, I got to pay more taxes over here. Or if I do this, am I going to pay less taxes? And the whole idea of a good financial strategy is it should reduce your taxes, reduce your fees and costs, reduce your risk, increase your asset protection, increase your wealth, increase your retirement income, and pass more to your family. If it's not doing those things, then why are we doing it?
And that's the $1 million question, isn't it?
Right. And most tax planning occurs very short. There's not a lot of thinking that goes into it. And what I find is that when you head to your CPAs, the CPAs are fantastic. They're doing a ton of tax returns, and you're basically reporting what happened. You're not being strategic. Unless you're working with your accountant on an ongoing basis, you're not being strategic and saying, well, what can I do today to reduce next year's tax burden? Mm-hmm. And that's something that you want to spend a lot of time on. But I keep coming back to this where I need to understand currently what's going on in my plan and all my income sources, and really get an understanding of how much federal tax am I paying, how much state and local taxes am I paying, how much FICA and Medicare am I paying, and under the current tax law with the current income that I receive for this calendar year, what is it looking like? Okay, great. Here's all my deductions. Here's everything I've taken. Here's all my assets. Here's all the portfolio, the dividends and the distributions and the interest and, tax credits and, depreciation allowances and everything I have across all of the items. Okay, that's the current plan. What can we change that's going to keep the income the same but increase the tax benefits, therefore reducing the tax benefits and not increasing risk and not increasing fees and costs? What can you do? A lot of different things. So it's not one miracle tax strategy. Like you hear the ads on the radio. You get paid no taxes. You hear all those things all the time. That's not what we're talking about, because those things are, anytime you're going to do 100% of something into something, it's never going to be a good idea, right?
Right.
Especially if I'm doing it for tax purposes, because as soon as a tax law gets changed, it's obsolete. And this is something that there's a lot of the things that you're reading about this tax law that may or may not get signed. Many of them are going to expire after a few years. So you're going to be right back in the same tax brackets that we're in today. They're subject to change. And I've been doing this for 27 years, I think, at this point. 1990 full time. Yeah, that's 27 years, right?
Your math is sound there, John. You are correct.
Right? Good, solid math. We are talking about a financial planning podcast here. For 27 years, the tax laws changed a lot. I think what people forget, during the Clinton years, on qualified retirement plans, there was an excise tax. And if you accumulated more than $750,000 in a qualified retirement plan, IRAs, 401ks, etc., and you died, the amount over the $750,000 was subject to a 15% excise tax. Translation into income, if you pulled more than $160,000 a year from that IRA sources, you were subject to an additional 15% excise tax on top of whatever tax bracket that you were paying. These are things that could happen again. I'm not saying that they are going to happen again, but I'm just saying these are things that were historically happening. And what we're seeing is that over time, when you look back, I did on my website, I have a video that talks about the history of the U.S. marginal tax bracket. And the theme of the video basically is this. The brackets have been higher, the brackets have been lower, and what typically happens is that when the tax law changes, you find yourself with more money exposed to taxation than you were before. So you take away, back in the 80s, prior to the Reagan tax law change, you could write off credit card interest.
Wow, that sure would be awesome.
Right? It'd be awesome. Yeah, then you'd want to have it because it would now be deductible debt. But these are things that they took away a lot of the deductions, so therefore more of your income was exposed to taxation. So maybe you were in a lower tax bracket, but you had more income exposed to taxation. So even though you were in a lower bracket, you might pay higher taxes, which is the fear of the eliminating the state and local tax deduction on the federal tax return, that even though they might lower the bracket, depending upon who the person is, they're going to lose their interest. They're not going to lose their interest deduction, but they'll lose their New Jersey tax, their real estate taxes. They lose that deduction, which could be significant for a lot of people, and they lose the benefit of that deduction, therefore paying more tax. So strategy, it's all about strategy, right? The strategy is important, and if you're not in a good position today, you need to get yourself organized so that in January or whenever this thing passes, or if it doesn't pass, I'm in a position to make really good strategic decisions about my tax planning. And the way to get clear on this is to sit down with your 2016 tax return. If you might own a company, and this is the best thing, right? If I own my own company, let's say I'm a physician or I'm a business owner, so and I'm a professional corporation, so I've got my S corporation return or my LLC return or my self-employment return. And I looked at that and I say, my gross revenue's here, I have interest deductions there, I have pension deductions, I have employee benefit deductions, I have rent deductions, I have all those things that are going on. Are those deductions as efficient as they possibly can? What can I do to increase the bottom line of the plan without affecting that, the profitability of that company? And then how does that end up on my personal tax return? Is that ending up on my personal tax return the proper way? And then when it's on my personal tax return, how does that get taxed? And am I taking the right deductions on that? So it's a 2 to 3 to 4 stage process. You might own your own business and own your own building that your business is in. Well, those two together need to be coordinated along with the personal strategy. So it's a very in-depth thing. I mean, there's a whole concept, what can I do to reduce the taxes? And that's going to be a theme that I don't think will ever go away, right? We'll always be wanting to reduce taxes, and we don't have control over what the tax law is, but we do typically have control over our strategy.
So when this new tax law gets passed, or if it doesn't get passed, let's make sure that we revisit this topic to dive into any major changes that are happening. But the onus of this podcast, the thing that I want everybody to take away from episode number 6 is you have to know, as John said, where you are now. In order to gauge where you want to go in the future, if you can't figure out where you are right now, then it makes everything a lot more difficult, and you can't do a lot of the tax planning and just overall philosophy that John talked about that today. So John, hey man, thank you very much for your thought leadership. I'm telling you, you spoke a lot of truth today.
Thank you. And in my final statement of the day here, I think once early next year, the sooner you get out, the sooner you make changes, the sooner you start making adjustments to your financial strategy, I think the better off that you'll be when it gets time to the end of the year next year.
John, thank you very much. And with that, if you have not subscribed to the podcast yet, make sure that you take one moment and click subscribe now below. That way, when John comes out with a new podcast, it'll show up right on your listening device, and it also makes it easier for you to share this with your friends and family. For John Smallwood, I'm Matt Halloran. Thank you very much, and we'll see you again very soon.
Smallwood Wealth Management is a registered investment advisor. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as the receipt of or a substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation.